Hello, students. I want to talk about another important concept that this chapter 22 covers, and that concept is known as IRR. Here it is, it's like IRS, IRR, internal rate of return. When it says rate, think about it as interest rates. It's a rate. Now we will talk about what it is. Let me start with this simple example. Imagine that you can go and borrow money, let me $1,000 here. And by borrowing this money from a bank, just think about it, from a bank, and then if you do that, think about yourself as a farmer. And you borrow 1,000. With that $1,000, you can buy a kind of old and used, let's say, tractor. And that tractor is going to bring every year $400. Do you see this $400 here? The first year is going to bring you $400, second year $400, fourth year $400, third year and fourth year. Now the question is that should you go and do this investment, buy that tractor trailer, knowing that after 4 years you have to trash it? One way you look at it quickly, you see that you are getting $400 every year for 4 years. You multiply this 4 by 4, it is $1,600. You say that you are borrowing $1,000 and you are getting $1,600. At first it might look a good deal, but it all depends of how much interest the bank is charging you. Imagine you borrow $1,000 and the bank is charging you 50% interest. That means the first year you have to pay $500 to the bank, second year $500, third year $500, and fourth year $500, and you only get $400 back. Therefore, that is not a good deal. Now, one way to see is that what is this R here? Can we calculate this R? Means that the return we are getting, what percentage of return we are getting. If the bank is charging you 8%, if this R is greater than 8%, then you will accept that project. You say, oh, I am paying 8% interest, but I am getting, a return of which is more than 8%. Then I am going to buy that, tractor trailer. How do we find out this R? Very easily, we use our calculator. Here we are borrowing 1,000. That is our present value, this $1,000. These $400 are cash flows or payments, the payments we are getting back. And then we have to calculate, and we know that the number of years is 4. It is 4 years. And therefore, all we have to do is to ask the calculator to calculate R for us. Or we can use the table at the end of the book. You remember for annuity, we went and used that table. Here we come and use our calculator. We click here. We say that the number, do you see this is our calculator.net? Let me show you how I got calculator.net. And then when I came here, I clicked on finance calculator. And then after I clicked my finance calculator, I want to click I. I means interest, means rate. Therefore, I click here. It is asking you for how many years are you getting those $400. That's for 4 years. It is asking you how much you are, getting from the bank, present value of the money. That is $1,000 I am getting from the bank. Now, what payments this tractor is going to give you? 400, but I put negative 400 because this $400 that I am getting is the opposite of this $1,000, because this $1,000 is going to my business, going out of my business, for example. I am borrowing, but this $400 is coming back to my business. Therefore, one of them is positive, one of them is negative. And in the future, the price of tractor is zero. It's junk. I am not going to get anything extra for a future value. And then I click calculate. And the calculation, do you see here, is 21.86. Therefore, if the bank is charging me 8%, and this tractor that I am buying is giving me 21% return, why not? I am going to go and borrow that $1,000 and get this trailer and therefore this tractor. Therefore, that is a good investment for us because the rate that this company, this tractor is returning is higher than the cost of capital. Cost of capital in my case was 8%. I used an example of the bank because it is just the borrowing. But I want you to know that it's not just the bank. It might be internal rate of return. I mean, it might be, retained earning. The shareholders are expecting 8%. That 8% comes the cost of capital. Weighted average cost of capital for this company is 8%. Now, if this is going to give me 21%, why not? I'm going to go and accept this project. Imagine I am going to, there is another project that if I go and instead of, I buy my tractor, also if I can buy, for example, if I can buy a truck also, a truck that way I can carry my tomatoes to the market rather than renting. That thing is going to give me $295 a month. Do you see? I put 295 and then I click calculate. This is going to give me only, that means if for 4 years it is giving me $295, the return I am getting is only how much? 6.9%. The cost of capital to me is 8%. But the money, the return I am getting is 6%. I'm not crazy to invest and go and buy a truck. It's better for me, let's say, to go and rent a truck rather than buying. Do you see that? Therefore, this is the way you accept the project as the chief financial officer or not. As I said, you can calculate this from the annuity table. This is an annuity that you are giving $1,000 for a period of 5 years, and they are paying you $295. And what is the rate that this annuity is giving is 6.99. I use the calculator here, but you can use both calculator or use the annuity table to come up and find about this 699. Let's look at another project, which is interesting one. Therefore, you understood this one. Therefore, you accept this project because it is giving you 21%. Then here it is. This is exactly what we put in the calculator. Payment of $400. Here, present value. Do you see it put negative here, but I put my negative in front of one. It doesn't matter. When you calculate it, as you all see, the calculator gave us 21.86 cents, and we are going to go and buy the tractor. And here, if you want to use the table, this is what the table is using it. Then we come here in the second case that if we should also borrow. Do you see here is net present value 21,000? It's a mistake. It's supposed to be 1,000 here. There is a number 2 extra here. Here you are going to borrow $1,000 from the bank, and you wanted to buy a van. No, I said van, but you wanted to buy a truck. That way you can take your products, tomatoes, to the market, and it's going to give you $295 every year for 4 years, and then after 4 years, that truck is going to be a trash. Therefore, the value, the rate that is returned to you is 6.97. This is what you saw here, 6.966, or the same as 6.97. There is an interesting case also, is that you have another option also. Do you see here? And it is, this is the case of the truck that is giving you $295 for 4 years. Therefore, you conclude that you will buy that tractor that, for your farm. But you are not going to buy this truck because its rate of return is lower than cost of capital to you, which is 8%. Here is the 8%, Therefore, it has to be above, the return has to be above 8% that you accept the project. This is another project. It is a little bit more challenging to calculate. Why? You are putting $1,000. Imagine this $1,000 you are borrowing. And with this $1,000, you are, for example, digging a well, for example. When you dig a well, That comes the first year, it's going to give you 250. The second year is going to give you 150, third year 330, and fourth year 450. There is a way to calculate also when we randomly put point 0.1 in here, and we see that if we put point 0.1 in there, eventually we do the calculation, we add all these numbers together, it comes to $906. Do you see at the bottom $906? We are putting $1,000 and we are getting back $906. Therefore, it's not a good idea to dig a well also. Why should we put there? Therefore, your question is that what rate should it be that brings me exactly to this $1,000 with trial and error? We can do that here. Rather than 0.1, we reduce this number and put suppose 0.07. If we put that, then suddenly it reduces the number. Do you see? It brings it to $1,002, which is exactly similar to this $1,000. This is a project at this moment. We accept the project, with that rate, and therefore here are 4 types of investment options that we have. IRR, internal rate of return, is when the first case of A case, that was when we bought a tractor trailer, it gave us a return of 20%. There is another project that gives us 16%. We accept this project as well because our cost of capital is 8%, and here the return is 16%. Therefore, we go for that. But we do not accept this project B. I gave an example of project B as if we buy a truck. We don't buy a truck, we don't borrow, because it's going to cost us 8% and it's giving us a return of 7%. And then we don't go and dig a well as well because we borrow $1,000 and it is giving us 6%. Therefore, we accept 2 of the project. As a financial manager, when the return of any project is greater than the cost of capital to you, you accept the project. Here it is 8%, as you see. If it is lower than that, you do not accept that, cost of capital. This formula that you see, although it looks like a little bit crazy, but it is the same formula. If you look at it, on C on the left side is $1,000. CF1, do you remember it was $400 for 4 years? That's the meaning of that. It's just they have put it in one formula. But at the same time, this what you see here is exactly what you saw in here. For example, here the example was for 400. You added that. Therefore, I want you to understand what IRR, internal rate of return. That rate is a rate that makes the $1,000 on the left side equal to the whatever is on the right side, and that is called IRR, internal rate of return. If you have any questions, you let me know.